You have to go look for it online. It will be right there in our YouTube channel. So we're going to give everybody about 30 seconds more to get on and join us before we begin. You have to go look for it online. It will be. And Michael, thank you for being with us tonight, sir.
Thank you for having me, of course.
Absolutely. And we are still waiting for our other co-presenter, I believe. And a good number of people still signing in. We will ask you guys to mute yourselves on the way in. There's Matthew. All right, perfect. Make sure that everything is all set up. We have about 30 seconds more to go. All right, everybody. So welcome and thank you so much again for joining us.
And she can start. She can be certain.
You a few friends here. Do please mute yourselves on the way in. So what are we here to do tonight, everyone? Well, I'll tell you just a brief background. I'm Nick Liebert from Exit Strategy Realty here in Chicago and across the suburbs. We have 4 offices, and our passion is making sure that all of our friends, clients, and consumers, as well as our realtor friends, have as much information as possible about all aspects of real estate. We actually have 4 key focus areas we discuss regularly and hold these consumer events. Those areas are health and wellness, personal finance, charity and community, and of course, what we're here to talk about tonight, real estate. We do have some people that, it's their first time buying. This might not always be information for them yet, but we want to everybody think in the long term of wealth building and legacy building in terms of real estate investing. And so it's not just about your first piece of property, it's about what you do with that property over time and as you expand your real estate portfolio over the years. But I am not the expert here this evening. I get the opportunity to sit back and learn from our friend Michael at Cadillus and Associates, who's worked with us on a variety of projects over the years and is great with our clients, as well as another expert in the 1031 exchange field. I will tell you one more thing before I turn it over to Michael and Matthew. One of the things that I made a mistake of earlier in my real estate career as an investor, as well as an agent, I think, but as an investor, was not always thinking about the exit strategy, pun intended, on the way into a property, is that I wasn't always aware of the tax consequences, how I could work on tax deferment, some of the IRS rules out there. And so I came into the business not always knowing the best things for a long-term strategic plan in wealth building. And so that's one of the things we wanted to help you all with tonight. We have some really exciting things coming up in the first quarter as to how to hold title to a property. We've done some past events on how to hold something in a land trust. But tonight we're really focused on if you've got a property in hand, an investment property, and there's some potential tax consequences, what are your options? So I'm going to go ahead and turn it over to Michael and to Matthew, if they wouldn't mind unmuting themselves. And then Matthew, I'm going to allow to be our presenter. He's got some wonderful slides to walk us through this evening. So it's going to be a lot of great content for you. And we appreciate you all being here. Please do hold your questions until the end. And so then that way at the end, we can have anything that you need. If you want to write them in the chat box to everyone, we can see them, or we'll even say, hey, go ahead and unmute yourself at the end. But we do want to hold the questions till the end so we can get Michael and Matthew through their presentation. So thank you, gentlemen, so much for being here. Michael, I'll turn it over to you, sir.
Thank you, Nick. I appreciate it. Hi, everyone. As Nick said, I am Mike Anselmo. I am the managing attorney of the real estate department of Cadillus and Associates. We're out of Burr Ridge, but we do stuff statewide. I do a lot of work with a lot of agents in your office, including Nick. And just real quick, I'll put my contact info, including my personal cell, in the chat. So I encourage you to reach out to me. We have a lot of good success working with your office. Nick, real quick from my part, asked me to present on 1031s, which I do quite a bit of them, working with investors, right? That's the first thing you should take away is for investment property only, right? What I told him is I wanted to get Matt Douglas involved. He is a JD. He's an expert. He works at Accruit, which our office works with a lot when we do 1031 for our investment clients. He has decided that his life is boring enough to go in and out of all the details of 1031s for stuff that I don't want to deal with, right? So before I let him get into his very exciting spiel, I just want to point out something to you guys on a regular transactional basis, right? You hear 1031, you hear tax code, timelines, deadlines. It's not something you should be scared of. There isn't much for you per se to have to do with your clients outside of letting them know this is an option, letting them know the basics of it, letting them know you know that information and you're providing them more information about investments and different opportunities they can use. But in reality, even on my part, the closing attorney, there isn't a ton for me to do outside of having a couple extra documents signed by the clients and kind of going over the basics. Matt and his team over at Accruit, they're going to go over all the tax related stuff with them, right? And it's just something you're going to see a lot of deadlines, numbers, and dates. Don't let it scare you, okay? You would get through one 1031 exchange and think to yourself, wow, not bad. Not as difficult as I thought it was going to be. With that being said, I do want to introduce Matt. You can see that handsome gentleman on the screen over there, ready to talk. And just a little bio on him. He's an experienced real estate attorney and litigator. So he started his legal career trying criminal cases in Chicago. And after that, he moved into commercial law and had his own practice where he did a high volume of residential and commercial transactions. So he's closed a lot of deals. He knows the ins and outs of our business. He's moved on since then to work for Accruit and specifically focus on 1031 exchanges. So he's an excellent resource. Like I said, my office uses them to consummate our 1031 transactions. With that, Matt, I will let you go ahead and do your thing.
Thank you, Michael. Appreciate the shiny endorsement. Thanks for the opportunity to nerd out on 1031 exchanges here, which are near and dear to my heart. As Michael said, you know, I'm a recovering attorney and moved into this industry a couple of years ago and haven't looked back since. And my goal with these kinds of presentations are to essentially come at this from a fundamentals plus perspective. I hope you take away a few things from this. As Michael said, I don't think it's realistic, nor do I think it's necessary for you all on the agent side to develop super deep knowledge on how exchanges work. But it's an opportunity to set yourself apart from the competition, to develop a working knowledge and be able to advise, at least in some capacity, on how exchanges work. You can learn when to make a recommendation for somebody to consider doing an exchange. You can learn fact patterns that disqualify people from doing exchanges, and so nobody wastes their time looking into it. And I'll tell you what, we routinely get calls from people who just maybe closed the sale of relinquished property. We call the property that's sold into a 1031 exchange relinquished property. They might learn that 1031 exchange is an option after they close a sale. 99 times out of 100, it's too late. Can't do an exchange once you've already closed. People get upset. Why didn't my agent tell me that this was an option, et cetera, et cetera. So knowing that this is out there, kind of understanding what the common, factual scenarios are where exchanges, might be called for, I think that's extremely useful for you all on the agent side. So with that, I'm going to get into it. I'll cover a number of things here. I'll try to keep it to about 30 minutes, and please do, keep track of your questions. Nick, am I going to be able to, oh, here we go. I can share my screen. Just give me a second here. All right, are we good? No, we're not. How about now?
There we go.
We see that? Yeah. Okay, great. Okay. Introduction to 1031 exchanges. So we're going to cover a few things. I'm going to tell you what, let me actually start the slideshow here. Okay, there we go. I'm going to cover what a qualified intermediary is. If you're going to do one of these, absent some very exotic variations of 1031 exchange, you're going to need a qualified intermediary. That's one of the things that we at Accruit do. We provide qualified intermediary services. In Illinois, you're going to have someone like Michael representing party to the transaction in every single deal. You're going to have a broker. You're going to have a title company. If you want to do a 1031 exchange, none of those parties can provide the service that you need to do one of these in the correct way, in the way that it's required to be done under the rules. You need a third-party qualified intermediary in almost every single scenario. We're going to talk about what that means. Mike mentioned some sort of intimidating timing requirements. I'm going to explain what those are. And while there's no need to be intimidated by them, they are very strictly enforced. And if an exchanger can't comply with them, then they can't do an exchange. One of the fundamental requirements is selling real property and acquiring like-kind real property. I'm going to explain what that means. Qualified use, Mike already said it. You can only do exchanges with business or investment property. There's also got to be, in most cases, a holding period established. There has to be an intent to hold property for it to be qualified for 1031 treatment. Flippers, somebody who's going to acquire dilapidated property, fix it up, sell it for a profit, by definition, disqualified from 1031 treatment. And there's something called the same taxpayer requirement that I'm going to explain. And then there's also the economics of exchanges. The values of the respective properties involved when somebody's seeking to do one of these is very important, okay? So let's get into it. First, how do you figure out what somebody who's looking into selling business or investment property and are going to realize some capital gain? That's the idea. Maybe they bought it 20 years ago and it doubled in value. Maybe there's a more modest capital gain. That's the idea, right? You sell property for appreciated value and to realize the profit. How do you figure out what the ultimate tax liability is going to be? I've found in my experience, both as a practicing attorney and in this industry, a lot of people have no idea how to calculate what their tax bill is going to be. So I'm going to run through that. I think this alone, if you have an investor client or a client who owns commercial property, isn't that sophisticated in terms of the tax aspects of their transaction, you can give them a rough idea of what their exposure is going to be. And that in itself adds value, whether or not they do a 1031 exchange. So I'm going to use an example in this presentation of somebody selling $1 million property that they paid $600,000 for, at some point prior. Okay. And we're going to use that as the basis for some of the discussions of the economics at work in these kinds of deals. So number one, if somebody sells property for $1 million that they paid $600,000 for, let me start with another example. Let me tell you what does not determine tax liability, which a lot of my former clients have thought this way. If you sell $1 million property, maybe you're carrying a large amount of debt on it. Maybe there's a $700,000 mortgage. Okay. So if you sell $1 million property, after debt payoff, you're netting $300,000. Put closing costs, and at my own risk, I always say I should never say forget about broker's commissions when I'm speaking to a room full of agents. But for the time being, just put it to the side for illustrative purposes. Okay. So selling $1 million property with debt of $700, net of $300,000 in sale proceeds, a lot of people figure, hey, that's my taxable amount, right? I'm going to pay some percentage of tax on my actual cash profit. Not the way it works. Mortgage debt does not figure into the calculation when you're determining tax liability. What does is the tax basis of a property. So in my example, somebody's selling for $1 million, but they bought a property, say 10 years ago for $600,000. That's the starting point for their basis. Okay. $600,000 is the basis, and that's what determines what the ultimate tax liability is. To break it down in its simplest terms, selling a property for $1 million that you paid $600,000 for results in a gain of $400,000. Okay, the $400,000 tranche of money is what's going to be taxed. Say the building is incredibly over leveraged. Maybe they have no equity in it at all. Maybe they're bringing money to closing. Maybe they got $1 million mortgage. They're not going to walk away with any cash. Doesn't affect the fact that the $400,000 gain is still going to be subject to tax. Okay. Now, how is that taxed? In a few different ways. Okay. So, number one, most commercial or investment owners will take depreciation over a period of time. I won't get too far into the weeds on that. It's kind of complicated, but upon acquiring investment property, typically an investor will work with their tax advisor, come up with a depreciation schedule, and that will reduce their tax liability year over year during the period of ownership of the property, but it also reduces their adjusted basis, which results in a higher tax bill. Okay. Low basis is bad. Low basis means there's going to be a high tax bill. High basis, from a tax perspective, is a good thing. So, number one, in my example, let's say somebody depreciated their $600,000 property by $100,000 over their course of ownership. Okay, that's tranche of money number one. Okay, so there's $100,000 there. The remaining $400,000 of capital gain is also taxed. How are these figures taxed? Number one, the $100,000 is taxed at 25% depreciation recapture. Number two, the $400,000 is taxed at between 15 and 20%, depending on the taxpayer's income level. There's also something called the net investment income tax, or Medicare tax, or Obamacare tax, 3.8%, that certain individuals with a high income have to pay. And then there's state capital gain tax, varies by state. In Illinois, it's 4.95%. So if you're dealing with an Illinois resident, you can tack that onto it. So if you have somebody who's in this fact pattern selling for $1 million with the basis that I just mentioned, they're looking at somewhere between a 30 to 35% total tax on that $500,000, $400,000 gain, $100,000 in depreciation recapture. So that is, it's late in the day. My math skills are, they deteriorate as we go on, but you're looking at, I don't know, maybe $175,000 tax bill. That's the amount of money that somebody will have to pay on these facts. So it's a great fact scenario, right? Somebody's about to cash in on a property that's, almost doubled in value. And then they realize, oh, wait a minute, I'm going to have hundreds of thousands of dollars to pay to Uncle Sam here. And very few people want to do that. Okay. We'll talk about how to avoid that. This field over here, net adjusted basis, we don't really have to get into that, but you can add on to your basis the value of capital improvements that you've done to a property over the course of ownership. So in my example, if somebody put $100,000 worth of work into this hypothetical building, that increases the basis by $100,000, which ultimately decreases the tax liability. But what's the headline here? This is an example using somewhat different numbers. In this example, somebody sells for $900. They've got closing costs. They've got a low basis. Maybe they bought for $300. They depreciated $80,000. Maybe there's $600,000 of gain. So I think from the agent's perspective, number one, bells should be going off if you see a scenario like this. Somebody's selling for significant dollar value. Somebody who's owned a property for a long time, find out what they paid for it. Somebody's selling for $900,000, a building that they bought 20 years ago for $300,000. Ding, ding, ding. There's going to be a huge tax bill associated with this. Okay. In this scenario, and forget about going into the specifics, but running this through the calculus that I just described, you're looking at a $210,000 tax bill on a property that's not even worth $1 million. So it's a huge incentive for people to do a 1031 exchange because they don't have to pay any of this in the short term. This tax deferral, the tax bill doesn't go away, and I'll talk more about that. But in the short term, they don't owe any of no depreciation recapture, no state or federal capital gain liability when someone properly does the 1031 exchange. And, broken down from a numbers perspective, this person didn't do an exchange. They just cashed in on their profit, and they're realizing $610,000 after taxes. If you're going to do an exchange and you can defer all the tax liability, you've got $820,000 to use to acquire replacement property. Okay, so it significantly increases purchasing power for new property. And one way to look at this is an interest-free loan from the IRS. The IRS is saying, you know what, this $210,000 that you owe me, you don't have to pay me right now, and we're not going to charge you any interest. So anyway, long periods of ownership, people who paid a lot less than they're selling for, those are kind of, should tip you off to might be a good fact scenario for a 1031 exchange.
Hey, Matt, let me jump in real quick here.
Please.
Just a quick point. That first two slides, that highlights exactly what I was talking about. Matt's just showing you those slides and those examples so you can see the difference of what's going to happen to your client. My head was spinning with some of those numbers he was throwing out. That's not the part you need to focus on, just the part that is it can be advantageous to your clients and why, not necessarily the ins and outs of those numbers. Just keep that in mind.
Right, exactly. And, when it comes down to it, I think take that, sit with it, at least break down conceptually what amount of money is taxable. And then in Illinois, slap like a 30% rate on that. So you can give somebody, somebody comes to you, a client comes to you and says, what am I going to owe here? And you can at least give them something like an approximate range. Then you send them to me, you send them to their accountant to break that down in more specificity. But yeah, you don't have to be a math whiz to know that if somebody has got a, $1 million gain, there could be a multi-$100,000 tax bill associated with that sale. So let's talk about what 1031 exchanges are and how to do them. Okay. The name 1031 exchange comes from the code section that establishes what these exchanges are. Section 1031 of the Internal Revenue Code. Okay. I've highlighted and underlined a couple things here that we're going to talk about. No gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment. That's the magic language. Held for productive use in a trade or business or for investment. If such real property is exchanged for like kind property, which is also to be held in the same way for use in a trade or business. Okay. Only business and investment property. Only if there's an intent to hold it. Only if the relinquished property, so the property being sold is referred to as a relinquished property, the property being acquired is referred to as replacement property. There's got to be a holding period established for relinquished property, and there's got to be an intent to hold replacement property in order to qualify for 1031 treatment. Okay, again, dealer property, which is the term of art for people who are going to flip a home and sell it, doesn't work. Okay. So you have a client who wants to do this. What do? Okay. You call me or you call another QI, qualified intermediary. We throw the term QI around for short. Okay. Like I said, in all practical purposes, you have a client that wants to do a 1031 exchange. It is absolutely mandatory that they engage a qualified intermediary before any of the deals close. Okay. In the typical forward or deferred exchange scenario where somebody's selling first and buying second, I'm going to mention a variation on that called reverse exchanges. Lost my train of thought. In those situations where relinquished property is being sold first, QI has to be brought in, and there's some things that have to happen before that relinquished property sale closes, okay? In practice, we don't need a lot of lead time. Plenty of exchanges get set up a couple days before closing, creates a little bit of a fire drill. We prefer like a week or more. But nothing's broken. Even some, there are plenty of occasions where someone's at the closing table. They decide they want to do an exchange. We can almost always put it together like that. Okay. But it's got to happen before settlement statements are signed, before money changes hands. Okay. I'm going to come back to this. Here's how this goes. Okay. Select a QI. You're going to use Accruit. All right. Ideally, this happens early on in the timeline. It doesn't always happen that way. Okay. Relinquished property is listed. Closing day is day 0. Okay. I mentioned the timing requirements, which I'll go through. But what happens at the first closing, the relinquished property sale closing? The money does not go to the taxpayer. The taxpayer or the exchanger are interchangeable terms. That's who we call the client here. That's who's doing the exchange. The owner of the relinquished property is going to buy new property. The money does not go to them. If they are in actual or constructive receipt of the sale proceeds, the exchange is blown. Okay. One of the things that we do is we act sort of like an escrow agent. The proceeds come to us and we hold them for the benefit of the exchanger. Okay. This timeline happens. They figure out where they're going to go, what property they're going to buy with their exchange proceeds. And then we send the money into the title company or whatever, escrow officer, sometimes it's an attorney's office, is handling the sale. But that's the flow of funds. Okay. The funds go directly from relinquished property sale closing to us. We hold it and we send it to where it's going. Okay. Doesn't matter if there's more than one relinquished property. Doesn't matter if there's more than one replacement property. This same flow of funds has to happen every time. Okay. Conceptually, what's actually happening here is the QI is serving a couple roles. Number one, we hold the funds to avoid actual or constructive receipt by the taxpayer, which blows the exchange. Okay. Number two, in order to actually receive 1031 tax deferral treatment, an exchange has to happen. Okay. Decades ago, the law kind of caught up with the reality of how people actually buy and sell real estate. Because in olden times, you actually used to have to do a swap of properties. I have property A, Mike has property B. We trade. I take his property, he takes my property, and we can defer our respective capital gain by doing that. But that never happens, okay? What happens is I want to sell my property to a third party, and I want to go buy Mike's property, and he wants to do his own thing, okay? So in reality, I'm not really exchanging properties with anybody. But by involving a qualified intermediary, there's academically speaking, an exchange happening, because what happens is the contract rights in relinquished property and replacement property are actually assigned to the QI as part of this. That's another reason why there has to be a QI involved before anything closes, okay? Because the rights under the contract have to be assigned to the QI. Because then what's really happening is I'm, in very crude terms, I'm selling my relinquished property to the QI, and then I'm buying my replacement property from the QI. So I'm swapping with the QI. It's a total fiction. It's not actually what's happening, but it's required under the rules. Okay, so that's another reason why it's structured this way and why you've got to get my company or another QI involved before anything closes.
Matt, let me ask you something about the QI.
Yeah.
So me and Nick have a deal. I'm buyer's attorney. Nick's the agent. We want to close. We want to do a 1031. Can I, as the attorney, be the QI? Can Nick, as the broker, be QI? Can Uncle Tom be the QI and hold it for his nephew?
Excellent question. Uncle Tom's a more complicated answer, and probably not, but maybe. Whether he's a disqualified person or not. But you, as the attorney, and Nick as the agent, who's in a direct agency relationship with the taxpayer, are categorically disqualified from doing this service. Okay, that's why you've got to get a neutral third-party qualified intermediary. Uncle Tom, maybe. You probably don't want Uncle Tom doing it because he doesn't know what the hell he's doing. But different conversation. Plus, there's not often going to be an Uncle Tom. There's always going to be an attorney. There's always going to be an agent. But no, they can't do this. It's got to be a third party. Okay. while we're on the topic, how much does this cost? Okay. Fees are relatively modest for this service, depending on the value of the properties involved. The fees that the taxpayer will pay to us range anywhere from between $1,100 at the lower end to, I mean, if you're talking about multi-million-dollar properties, $2,500, but it's usually under $2,000 in most circumstances with properties kind of sub $3 or $4 million. So yes, there's some additional expense involved. Yes, there's a fee that your clients are going to have to pay QI, but relatively speaking, relative to what they're paying you and what they're paying the other parties involved in a deal, it's relatively modest.
Hey, let me ask you this. It's from Dana, but I think it's better to ask it now than to come back to it.
Yeah,
QI
absolutely.
state specific. So
No,
you don't
no,
have to have
they're
an
not.
Illinois QI.
Correct. And in fact, so Accruit, I'm based in the Chicago area along with one of my colleagues, but Accruit's headquartered in Denver. We've got people all over the country. We've got a big presence in Montana. We're on the East Coast. We're in California. There are a few states that require QIs to be licensed. We're licensed in all of them. Illinois is not one of those states. So you might get a weird situation where a QI is not licensed in Idaho or something. But no, you don't have to get there's not Illinois specific QIs, and we're licensed in all 50 states. There's only like 4 or 5 of them that require it. Good question. By the way, well, we'll talk about it when we get to like kind property, but that raises another question. Somebody's selling out of Illinois, they want to go to Florida, they want to go to Texas, they want to go to California. Can someone sell relinquished property in one state and buy replacement property in another state? And the answer is absolutely yes. Okay, the timeline. This is one of the most salient things to know about how 1031 exchanges work. There are 2 concurrent timelines that run upon the closing of the first relinquished property sale. Sometimes there's 2 or 3 relinquished properties being sold. This timeline starts running as of the first sale, okay? The first is a 45-day identification period. The exchanger, starting from the day of closing, doesn't matter what day they went under contract, doesn't matter what day they list, doesn't matter. What matters is the day that the property is transferred to their buyer. Okay, from that day, they've got 45 days to identify replacement properties. There are a couple rules around identification, but the simplest one and the most common one is they can identify up to 3 potential alternative replacement properties, and they can close on any one of them and be fine. Okay. In the market, the way it's been over the past couple of years, this has presented a big challenge for a lot of people because inventory has been so low. But it's the rule. If you can't identify property within 45 days, or you identify one and then on day 60, the deal falls apart for whatever reason, and that's the only property that you identified, tough luck. Can't do an exchange. Okay. So you've got to identify the property or a batch of properties, and you have to actually acquire at least one of them within 180 days of the first closing. Okay. So they've got 6 months to actually close. Something happens with their loan on the replacement property, something happens with inspection, whatever, closing gets delayed to day 185, tough luck. Can't do an exchange. There's a lot of gray area in 1031, and I deal with a lot of very sophisticated kinds of exchanges that we almost operate entirely in the gray. This is not one of them. If an exchanger can't comply with the 45-day identification period or actually acquire replacement property within 180 days, they're out of luck. Tax fraud is the only way they can claim that they completed an exchange, and obviously nobody wants to put themselves in that position. Okay.
Hey, 2 quick questions on that.
Yeah.
How do they identify the properties? What's the process?
Good question. You can do it in a couple of different ways. The way we handle it is we have a form. You can make the identification to any party involved in the transaction, including the QI. Okay. So on day 40, whatever, 42, and leading up to that, we check in with the taxpayer, and we have a particular form that allows them to make the identification and then give it to us. And we have software that makes a lot of this seamless and paperless. As long as it's given to us as QI, then they're in compliance with the rules.
And for everyone listening, you should identify it to the QI. That should be the person you're going to. It's going to make everything a lot easier.
For sure.
Now, my second question, which I get this question a lot, is you say tough luck if it's on day 181. Well, what's the penalty? What happens to the person?
Assuming
that they didn't close.
Yeah. Well, then they owe, in the example that I provided earlier, where there's a tax bill of $210,000 or whatever, they're on the hook for that. If they can't acquire property within the time periods, and they can't successfully complete an exchange, then they just sold the property as part of a regular taxable sale.
And they're back in the same spot then as if they didn't even try. So there is no, hey, IRS, we're going to hand you down a $5,000 penalty for not closing on day 180. They're just
no, there's correct. There's no sanctions or no penalties. You tried and you failed, and you just owe the tax, and you're in the same exact position that you were before, with a caveat, which is that if your exchange straddles tax years, say, it's December right now, I sell relinquished property tomorrow, and I identify something, but it falls apart in February. I don't get my money until 2023. I can actually report the gain in the 2023 tax year rather than the 2022 tax year. That's actually what it defaults to. So there's some benefit in kicking the can down the road in terms of the, when you actually have to pay the taxes, but that's it. Otherwise, it's just a taxable sale, and like any other sale. All righty. What is like kind property? So in the statute that I shared, that's one of the requirements. You're selling property and acquiring like kind property. Okay. This is very simple. Two things. Number one, only real property qualifies for 1031 tax deferral treatment. Okay. Up until 2017, you could do it with certain kinds of personal property. Can no longer do it with any kinds of personal property, like airplanes and fleets of rental cars. That used to be a very active area of exchanges. Law changed in 2017. Only trade real property. Okay. But doesn't matter what kind of real property, as long as it's held for productive use in a trade or business or for investment. So if I have a single family home that I hold as an investment property, and I want to go buy ranch land in Montana, or I want to go buy a commercial office building in Florida, I can do that. Generally speaking, all real estate, provided it's business or investment property, is like kind to all other real estate. Okay. You don't have to trade a 2-flat for another 2-flat. That's a question we get all the time. It can be any kind of real property. Okay. Not to beat this to death, I think we've made the point that it's business or investment property. There's a holding period. If you have somebody that has only owned relinquished property for a few months and they want to sell it into an exchange, can they do that? Maybe. Depends on what their intent when they bought it was. There's no particular time period required to qualify for 1031 treatment, but we like to see 2 years. That's kind of the rule of thumb in this industry. They've held it for 2 years. There's almost certainly sufficient holding period. No flippers, no, like I mentioned, no buying property to fix it up and sell it for a profit. That's referred to as dealer property. It doesn't work. Vacation homes or second homes, maybe. There's some rules around when second homes qualify. And what it boils down to is for a couple years before an exchange as to relinquished property, or a couple years after an exchange as to replacement property, there's got to be very limited personal use by the taxpayer, and it's got to have been rented out for at least a couple of weeks in each of those years. Okay. So most of the time they don't qualify. Sometimes they do. Segueing into, let me make this point real quick. I don't know, this group sounds like there's probably a mix of residential and commercial properties involved with you all. So you've got primary residences and you've got investment properties, okay, with two sets of rules that apply as far as the tax implications of those, okay? Section 121 is what allows homeowners to exclude a certain amount of capital gain from the sale of a primary residence, okay? So categorically, a primary residence not eligible for 1031 treatment, period, no matter what, okay? But they can, somebody who's selling their primary home can exclude $250,000 or $500,000 worth of gain, depending on if they file singly or jointly. And that's a tax exclusion. So if you sell, in my example of somebody they're selling their home for $1 million and they paid $600,000 for it, and they have a $400,000 gain, and they file their taxes as a married couple, there's no tax liability associated with that at all, because it's all excluded under Section 121. Okay, it's a tax exclusion. They never have to pay it. Contrast that with Section 1031, business or investment property. As we've said, Section 1031 is a tax deferral, not a tax exclusion. So if I don't pay the tax on my $400,000 gain because I trade into eligible replacement property and I hold it for a period of time, I don't owe anything now. But what if 5 years down the road I decide to sell that property and cash in? Well, then I owe the tax from the gain on the replacement property, and I have to pay all the tax I deferred from the sale of the relinquished property. Okay, so something to keep in mind, there is a way around this, which is to die while holding your replacement property, which is a strategy that's so common it has a name. It's called swap till you drop. So some people will, acquire replacement property and just keep trading it into new property. You can do unlimited number of exchanges. I can own property 1, exchange into property 2. Years later, sell property 2, exchange into property 3, and I can just keep doing that into perpetuity. And then if I pass away while I'm holding whatever replacement property and it goes to my heirs get a stepped up basis, which means the fair market value of the property becomes their basis. High basis is good. It means low tax bill. So anyway, something to keep in mind. But the point is, there are two different things, 1031 and the exclusion you get from the sale of the primary residence. And you can do 1031 exchanges as many times as you want. There are no limits on amount of gain that you can defer. There are no limits on how many properties you can exchange in a given year. There's been some legislation floated that looks like it doesn't have the traction that it needs to get anywhere. And we're all in the industry, obviously knocking on wood that stays that way. So as for now, you can do them all day long, as many as you want. Okay, getting pretty deep into the presentation here. Let me see. Okay, let me make a couple more points. We can be brief here. There's something called the same taxpayer requirement. Okay, you may have a situation where mom and dad own investment property. They want to sell it for another one, and they either want to gift it to son, or they want to get son on title, or something like that. Not a good fact pattern for a 1031 exchange. Whoever the taxpayer is that owns the relinquished property has to be the taxpayer that owns the replacement property. Okay. Taxpayer, not record owner. Okay. Because there are a couple of kinds of entities that are called tax disregarded entities. So if I own relinquished property in a living trust, the living trust, it's as though it doesn't exist for tax purposes. It's disregarded by the IRS altogether. The asset is reported on my individual tax return. Same thing for single member LLCs. You see that a lot, especially in the investment world. Somebody sets up 123 Waller LLC to own a 3-flat or something. There's only one member. I'm the single member. The LLC is not a taxable entity. It's a tax disregarded entity. So I can acquire replacement property in another single member LLC or in my individual name. But the taxpayer has to be the same. A very common scenario is you might have a multi-member LLC, which is its own taxpayer, or an Inc., which also is its own taxpayer. Those are not disregarded entities. You've got one guy who wants to cash out, you got another guy who wants to do an exchange. How do you handle that situation? There are a couple different ways to do it. Kind of complicated. Sometimes it usually can be done, but it requires some advanced planning. And that adds a layer of complication, because whoever the taxpayer is in the old property has to be the owner of the new property. Okay, we can talk more about that if questions arise, but that's the basic rule. Value. This is critical. Okay. In my example, I'm selling $1 million property. How much replacement property do I have to acquire to completely defer all my taxes, all that depreciation, recapture, and state and federal capital gains tax? Okay. You have to buy replacement property of equal or greater value than the relinquished property. Okay. It's not sufficient to just buy replacement property in the amount of your gain. So in my example, where I have a $400,000 approximate capital gain from the sale of my $1 million building, a lot of people call me and say, I don't understand. I just want to spend a gain on a replacement property. Why can't I do that? Because the rules say you can't do that. There's the concept that underlies 1031 exchanges is allowing that would be contrary to it. It's called continuity of investment doctrine. Anyway, you've got to buy if you sell $1 million property, you've got to buy $1 million property, minus only closing costs and broker's commissions. So you can get your commissions paid with exchange funds, and they come right off the top. Okay. So if I have $1 million property with, put a round number on it, $100,000 in closing costs, transfer taxes, title fees, broker's commissions, maybe I give this seller a credit for a roof repair, something like that, then $900,000 is my exchange value. Okay. That means I have to go buy $900,000 of replacement property. What does not get subtracted from that value is my amount of mortgage debt. Okay. You have to replace your mortgage debt if you pay mortgage debt off on relinquished property. So if I have $1 million sale and I pay, going back to one of my first examples, I pay $700,000 mortgage off on that building when I sell, and I only have $300,000 cash in hand, I don't only have to spend $300,000 in replacement property. I've got to spend the full $1 million minus the 100 in closing costs, so $900,000. So I've got to bring whatever I net, whatever I walk away with from a sale, I've got to put that into replacement property. Any cash I put in my pocket is taxable. It's called boot. That's I even have a graphic there. I forgot about that. Boot is taxable. Okay. So if I net $300,000 and I put $100,000 in my pocket, the $100,000 is subject to tax. Okay. Same thing if I pay off mortgage debt and I do not replace that debt in new property. So if I don't go and I don't get a $700,000 or more debt in replacement property, then whatever I don't replace is taxable in just the same way that cash would be. Okay. The only difference with mortgage debt and cash that you walk away with is mortgage debt can be handled in one of two ways. You can either get a new mortgage on replacement property, or you can bring new cash into replacement property. So if somebody's in a strong capital position and they have $700,000 they can put into new property, they can offset the mortgage that way. But rule of thumb, equal or greater value to get a full tax deferral. You can split it up and do a partial exchange and cash out on a portion and just pay tax on the portion that you cash out on. That's fine. Doesn't always make sense to do depending on what your basis is, but it is allowed. Okay. Last thing I'll say.
Hey, Matt, let me ask you a real quick question on that last slide before you get into this.
Sure.
So with the 100,000 or the $1 million property, you say you have to do $1 million if you want to recognize the full benefit. You have to do $1 million replacement property. Can you do two $500,000 properties as replacement? Very
good question. And yes, absolutely. Subject to identification and exchange periods, meaning you've got to identify both of those replacement properties within the first 45 days. You've got to acquire both of them in the 180 days following the sale. Okay. Good question. Similarly, some people want to consolidate their real estate portfolio. They might want to sell 3 or 4 relinquished properties and trade into one larger property. Also fine. They can also do that. And it's also subject to the same timing requirements that start running as of the first relinquished property sale. Okay. So as of the first sale, you've got to identify replacement property 45 days after the first sale and acquire replacement property 180 days after the first sale. And then whenever the other relinquished properties close, you just drop them in as you go, but you're still, you still have to abide by those timelines, with the caveat that there's some ways that you could break up individual interests. If you're selling multiple relinquished properties and acquire tenant and common interest and replacement properties, but it's complicated. But there are ways of extending out the period, but it gets a little hairy sometimes. What if you have somebody, and this is what I do all day long, I do reverse and improvement exchanges, okay? Most of what I've discussed, all the same rules apply, but the quintessential 1031 fax pattern is relinquished property is sold first, and then the value from that property is used to acquire replacement property. Doesn't always work out like that, either on purpose or because there's a delay in the relinquished property sale. Okay. So can somebody go buy and close on replacement property first before they've sold their relinquished property? And the answer is yes, there is a way to do it. It's a lot more complicated. It's a lot more expensive, but it's doable. And it involves bringing a third party called an exchange accommodation title holder into the mix that actually goes and buys a replacement property and parks it for you. That's another thing that we do. A lot of QIs don't do these kinds of, we call these parking transactions. But there is, some people don't want to sell because they're, especially in the market, the way it's been in recent years, because there's a 45-day identification period to contend with. Why am I going to sell a perfectly good property if I'm going to go, roll the dice about whether I can find a suitable replacement property? So this is a way that someone could go out, find the property that they want, scoop it up, and then sell the relinquished property after, subject to the same 180-day timeline, except in reverse, okay, with a bunch of caveats that I'm not going to get into right now. Improvement exchange. What if I sell my $1 million property? I find a nice $700,000 property that I want to rehab because I'm going to, realize a lot more income from it if I fix it up. Can I spend $700,000 of my exchange value and then use the additional $200,000 to $300,000 on improvements to that property? Yes, you can do that too. It utilizes a similar structure as a reverse exchange with an exchange accommodation title holder. And the work's got to be done within the 180-day time period, which is a big problem for a lot of big projects. That's when we get into non-safe harbor reverse and improvement exchanges. They get even more complicated, which we can save that conversation for another time. But there are options for both of these structures that we have a lot of experience with at Accruit. I will stop there and let you all ask questions.
Yeah, that was excellent, Matt. I do want to let everyone know there, that last slide, that gets really, really hairy. I think the takeaway is those things are possible. If you have a client thinking about it or you're suggesting it, that's where you certainly want to reach out to Matt first to discuss that, because those can get tricky. There's a few questions in the chat. I'm going to ask you one big question. Now, this is getting more maybe into the financial planning aspect of things, but if I'm the buyer, I'm deferring taxes. Well, I'm paying the tax bill anyways down the road. Why am I kicking the can down the road? Why am I just not paying my taxes right now?
It's a good question, and it's one that a lot of people ask. Part of it has to do with purchase power, because like I said, this is akin to an interest-free loan from the IRS. So you can go pick up more replacement property than you otherwise would. But in my experience, people don't think that far down the road. You know what I mean? There's an opportunity for tax savings right now And there's no, yes, you pay the tax in the future, but there's no downside now in that it doesn't increase your tax liability because you're doing a 1031 exchange and deferring taxes down the road. So, I mean, there could be a million variations in somebody's individual circumstances why they don't want to pay it now, or they want to buy property A and they can only do it if they do an exchange. So, I think there are a lot of answers to that question, but the idea of not paying anything now and using that money to go buy, more property is very appealing to people.
Right. And I think the general answer for everybody, the takeaway would be you always want to defer paying your taxes. One, because of that purchasing power. And two, if you're doing things correctly, you have the right people lined up, you're going to be making a lot more money by not paying taxes right away and letting that money grow. A couple that were in the chat from Sam, question for later. Does depreciation roll over as well in the exchange?
That's a good question. You can't there's a complicated answer to that I have to sit down with pencil and paper to answer specifically, but you cannot depreciate replacement property as much when you acquired it in an exchange that you otherwise could. The rule, I forget what the rule of thumb is. I want to say that the amount of gain that you're deferring, the depreciable value of the replacement property may be reduced by that amount of gain. There's a concept called foregone depreciation that addresses this. So it depends on how much gain you're deferring and what the value of the replacement property is, but correct that there is an adverse effect on how much you can depreciate replacement property when you do an exchange.
Yeah. And again, I think the answer to that one is also transaction specific, and that's where you reach out to Matt and you ask him if you have a client asking those types of questions.
A lot of those things I say, and then you need to go talk to your accountant. Because
as long as you don't send them back to me, I'm fine.
Right.
Another one from Sam. If the money that is being taxed gets used in the purchase, does the taxpayer get to extend debts to the IRS?
Not sure I understand that question.
Yeah, I'm trying to figure this one out as well. So I think he was asking that when
after the 180
period, right? So the penalty, getting taxed because you missed the 180-day period. He's asking about that. Does the taxpayer get to extend debt to the IRS?
Yeah. So the way I meant to say is, like, let's say you have $100,000 to use in proceeds, and you use $100,000 in 2023. Do you have to pay your entire tax bill in 2023, even though you have no more money, or do you get to extend it into like multiple year payments?
Are you talking about a failed exchange where if you got $100,000 in proceeds, but you don't actually receive it until the following tax year? My understanding is you can do installment sale reporting. Installment sale reporting, like if you have a seller finance deal and you're only making $10,000 a year in payments, then that's the only amount that's reported in a given tax year. In this scenario where you receive your $100,000 in the following tax year, you don't have to report it until you report taxes for that tax year, but you receive the entire $100,000 in that year. So you've got to report the entire, you're liable for the gain on the entire $100,000. The only advantage is when you have an exchange that starts in year one and ends in year two is you don't have to report the gain until the year two tax return. So you can delay paying, but then when that year's taxes are due, you got to pay the whole thing because you received it all that year. Okay. This is one more thing to be aware of. This makes people really angry, but it's what the rules are. There's something called G6 regulations in 1031 exchanges. Somebody opens up an exchange, they can't get their money back from the QI until at least the 45-day period expires, okay? And if they identify property, the 45-day period expires and their deal falls through, but they have an active identification, then they can't get their money back until the 180-day period expires. So subject to if you can come up with a substantial contingency. There's some language that nobody can ever, hardly anybody can ever satisfy, but people don't like that. So I try to tell clients that. I try to make them aware that that is a consequence up front. Made me think that rule, I thought of it because we're in December. Maybe somebody's exchange ID period expires in December, but they can't get their money back till the 180th day. They're not getting their money back till 2023. And then that implicates what we're talking about as far as when you report that gain.
Okay, I got another one from Sam. It's not on the Sam, I love it. Keep it going, buddy. Not on the subject of 1031s, but it relates to one of the slides. And he's asking, if you're a 2-flat, second floor, second floor is your primary residence, you rent out the first.
Good question.
121 exemption. Now, I'll tell you this, it has to be reported. A certain portion is going to be taxed. But Matt, I'm not positive if you know that answer for sure.
Yeah, you can do that. You can. So we would allocate values. Unit 1, which is the principal residence, is whatever it is, X. Unit 2, which is the investment property, is Y. You take a 121 exclusion as to X, you can do a 1031 exchange as to Y. The trick there is coming up with a reasonable allocation, which usually involves going to somebody's tax advisor for help, but totally doable. We have a big presence in Montana. We do a lot of ranch land out there. Somebody lives in a house on 50 acres. They sell the entire parcel. How do we divvy up in this mixed use property scenario? How much is attributable to the residents? How much is attributable to the land? That's the trick in doing that, but that's how you do it. And then you can take the, act accordingly, depending on how the numbers shake out.
Nice. Okay. I see we're running up on the 7 o'clock hour. Want to respect everybody's time. Nick, I will share both of our information with you guys. Get in contact with us for, Matt 1031s, me for anything real estate related. But thank you guys. And thank you, Matt. That was fantastic. I certainly learned a lot from it. I'm sure. Well, I know Sam did as well. And I'm sure most everybody else did as well. So
I'm glad to hear it. And thank you, everybody.
This was really wonderful, guys. And we are at the 7 o'clock hour, but I will say this much is, this is the type of content we're going to be bringing to you again in the new year. Two different people that direct messaged me in the chat asking me, well, is this a good time to buy or sell as an investor? And I said, actually, if you're going to sell and buy as an investor, you can't get more of a safe market than a balanced market, a stagnant balanced market, which is where we're at right now. What that means is, if you're selling when the prices are going stratospherically high, and everybody's outbidding each other, like we saw for the last 2.5 years, it can be a great time to sell. But then what do you identify as the replacement property that you get at a decent price? Probably not as easy to make those numbers work. If it's a quickly declining market, okay, well, I can maybe buy something cheap, but am I going to get the decent price for my place? So you've got this kind of time period right now. A 1031 exchange may actually be a good strategy for you, and actually an opportune time in the market where it's not insane for sellers or buyers. It's kind of that balanced market where you should be looking with your Exit Strategy Realty agent. We have a very unique app that's going to allow you to set up a bunch of different types of filters, get access to the private listing, network listings. Sam is one of a client of mine that uses it. And I'll tell you, there is some price reductions. This is not a distressed property market per se at this point, but there are some sellers that have a lot of equity in a property that are going, look, I want to, for one reason or another, get out of this one, do something else, maybe retire with my money. Some of those long time property holders with significant equity in their property, they're the ones that may be apt to drop the prices significantly to get rid of something that could be you can still sell at a reasonable price and turn around and get something at a discount. So definitely get in touch with your agent from our office and be on the lookout, guys, for more great events coming in all our 4 focus areas. And then again, Michael and Matthew, thank you so much. And thank you, Sam, for asking some really pertinent questions this evening. Everybody, we appreciate you, and have a good night.